The Reserve Bank today reduced the official cash rate by 25 basis points to 2%. Global growth is below trend despite unprecedented levels of monetary stimulus. Considerable surplus capacity remains across most economies, and along with low commodity prices, is suppressing global inflation. Some central banks have eased policy further since the June monetary policy statement, and long-term interest rates are at record lows. Weak global inflation and the upward pressure on our exchange rate is causing negative inflation in the tradable sector and making it difficult for the bank to meet its inflation objective. A decline in the exchange rate is needed. Domestic growth is expected to remain supported by strong inward migration, construction activity, tourism, and accommodative monetary policy. However, low dairy prices are depressing incomes in the dairy sector and reducing farm spending and investment. House price inflation remains excessive and has become more broad-based across the regions, adding to concerns about financial stability. Annual CPI inflation is expected to weaken in the September quarter, reflecting lower fuel prices and cuts in ACC levies, but is expected to rise from the December quarter. Although long-term inflation expectations are well anchored at 2%, the sustained weakness in headline inflation risks further declines in inflation expectations. Monetary policy will continue to be accommodative, and our current projections and assumptions indicate that further policy easing will be required to ensure that future inflation settles near the middle of the target range. It's a very competitive market, and we don't want to end up directing banks on pricing. But it's a complicated thing for the banks, I think. If you look at their net interest margins, they've been generally trending down since late 2014, and they're not out of line internationally. So that's on the net interest margins. If you look at what's happened to, say, 2- and 3-year fixed mortgage rates, and that's most of the lending is fixed mortgage rates these days, the reduction in 2- and 3-year fixed rates over the last couple of years, or at least since we've been lowering the OCR since June last year, the reduction in those 2- and 3-year fixed mortgage rates has been more than the OCR. So it's a complicated assessment. They'll need to think about their competitiveness, competition in the sector. They'll no doubt think about the net interest margin and the fact that it's been falling. Their offshore funding costs have been rising a bit. They will need to refinance their positions at times, and when they roll over that finance, they're likely to have more expensive funding. Then on the other hand, the additional point I should probably make is that if you look at their credit growth, it's been growing more rapidly than their deposit growth. So, they're going to be out there competing for term deposits, and that's going to require, one would think, over time, higher interest rates in order to attract those deposits, particularly as the OCR falls.
Inflation expectations tend to move very slowly following outcomes of inflation, but the longer inflation is away from the target, the bigger the risk is, and the bigger the risk, the bank has to respond even stronger. You mentioned in the question, and other people have mentioned this, should you adjust the target in response? That's probably not going to do much because, again, the evidence is that when New Zealand has moved its target, and it's done so on a number of occasions in the past, all that you do is immediately alter inflation expectations down to the new level, so you achieve nothing.